Our market update for the 2nd of May 2012 is with RP Data's Director of Research, Tim Lawless. Welcome, Tim.
G'day, Anthony. Thanks for having me on the show.
Tim, some massive news yesterday, and obviously that's going to reverb through the entire market. So let's get to that in a minute, but first give me a rundown, if you can, on what the international property market's looking like, and then we'll go Australia, down to South Australia, and then let's get right into that interest rate thing. So how's the global outlook for property?
Well, it's still pretty glum out there in Australia. In many ways, despite the softness we're experiencing here, is pretty much the envy of a lot of the other Western world. So you're still seeing quite a bit of softness in the US. Our parent company at CoreLogic, which is quite a similar company to RP Data, they released their own analytics on the marketplace, which is showing more than 25% of properties across the US are what they term underwater, meaning the values are worth are lower now than what they paid for them. Compare that to Australia, where we're seeing about 6% of properties now lower in value, and most of those properties were purchased the last 5 years. The UK market seems to be showing some sign of improvement, but off a very low base. Look throughout the Eurozone, and the property market is certainly very depressed. Our nearest neighbours over in New Zealand, they're starting to see some small improvements in their property markets as well, after values fell by around about 10% from their peak.
So is there much concern about Spain? You know, is there a renewed sort of anxiety with regard to what we've heard in the last week?
Absolutely. I think the Eurozone has replaced the US as being really the epicenter of international worries now, not just from a property market perspective, just from a global economic standpoint, also from Australia's bank funding standpoint. A lot of our overseas funding for our banks comes from Europe. And just look at the covered bonds market at the moment. It's really struggling to get a decent yield out of overseas markets, which is part of the reason why the banks aren't passing on the full set of interest rates. I'm sure we can cover off on that a bit later on.
Right. So now, talk me through the Australian property market in sort of brief terms of where it's at and how that's looking.
Yeah, I'll give a quick roundup on each of the capitals. Broadly speaking, across the combined capitals, which provides a pretty good benchmark for Australia nationally, over the month of April we saw values fall by 0.8%. So that's a reversal of February and March, when we actually saw values show a fairly modest rise. So over the first 4 months of 2012, we've actually seen capital city dwelling values fall by 0.7%. So that's actually, even though it's a decline, it's actually a little bit better, I suppose, than we were tracking late last year. So it's an improvement in the rate of decline. But it still does suggest that property market conditions are relatively soft. Looking around the capitals, Sydney and Canberra seem to be the most resilient markets at the moment. Over the past quarter, this is the 3 months up to April, we've seen Sydney values increase by 0.9%, and Canberra values are up by nearly 2%, up by 1.7%. The other major capitals, Melbourne's looking quite soft at the moment after being one of the stellar performers during 2007, as well as during 2009 and 2010. So over the year now, values in Melbourne are down by 7%. That's the second worst performing capital city over 12 months after Hobart. Brisbane's starting to show some improvement in the rate of decline, but values are still going backwards. In that particular market, they're down 0.6% over the quarter and 6.4% over the year. The peak to trough, or the peak to current declines in Brisbane are now pretty steep. They've gone into the double-digit figures, so down about 12% from when they peaked back in April 2010. Looking at Perth, we're starting to see a real turnaround of the Perth market, even though values are still slipping backwards. Certainly not by as much as they were this time last year, even 18 months ago. So values in Perth are down by just 2.8% over the past 12 months, which is one of the better performances across the capitals.
Yeah. Now, Adelaide, most of our listeners are in Adelaide itself. How in South Australia? What's your take on, more specifically, with regard to our own backyard?
Yeah, Adelaide's been tracking fairly along the capital city average. Values are down by about 4.2% over the past 12 months, which is pretty similar to the national average, which is down 4.5%. Over the month of April, we actually saw a very small improvement in Adelaide values, but I think you'll find that's probably more statistical noise than anything else. Even over the quarter, we've seen a very slight rise of 0.7%. But the broad trend for Adelaide does show the sales volumes have been tracking down. The market is still relatively soft. buyers certainly do hold the upper hand at the moment. There's more stock in the marketplace now than there was at the same time last year. So still certainly a buyer's market, but we haven't seen, I suppose, material falls in property values in Adelaide.
Tim, could that be relating to the fact that there's a skew in who's buying? In other words, less of your first home buyers, a bit more activity in the higher price, which is keeping the median up? Because anecdotally out there in the world of real estate, it's been seriously tough on vendors and sellers, where some of the prices have been, pretty modest for what the properties are, or relative to our previous expectations. Any thoughts on that?
Yeah, absolutely. Our index isn't based on median prices, so it's not really biased by different buyer types. But I absolutely agree with you. First home buyers at the moment are pretty slim on the ground. They're still representing around about 15% of the overall market, or about 15.3%, which is slightly above the 10-year average. But keeping in mind that back in 2009, first home buyers rocketed up to about 27% of the overall market. Obviously being brought into the market by the very low interest rates and the first home buyers boost. So a lot of that demand was brought forward, and I think at the moment first home buyers are relatively inactive, and potentially also a lot of those buyers that bought into the market during 2009 are now starting to face some hardship. Potentially they overstretched themselves. Interest rates started going up soon after that surge in first home buyers as well. So it's probably not that good a marketplace in that affordable sector, but in the same sense we are still seeing some relative weakness across all the market segments, let alone the more affordable stock. More expensive housing potentially is travelling a little bit better in Adelaide. It's quite different in Sydney and Melbourne. So I think Adelaide is defying the trend a little bit in that respect. Yeah,
we definitely operate in that space, Tim, and I can tell you from the trenches that the top end has actually been the best and the easiest of the whole lot at the moment. So, and that, I know that defies what's happening nationally. Now, let's go up a notch, and 0.5% reduction Reserve Bank yesterday. The Flow and Effect Bank of Queensland, I think, are the only ones who have announced a reduction of 0.35 or something. What's your tip there, and is this marking the bottom of the market?
Well, potentially it is marking the bottom of the market. Like I was saying before, I think we're already seeing a reduction in the rate of decline, which is good news. A 50 basis point cut, at least in the cash rate, and as you say, Bank of Queensland announced the 35 basis point cuts. They've held on to 15. It'll be interesting to see what the big banks do. I'd say it's probably going to be somewhere in line with between 30 to 40% cut. Or basis point cut. So it's definitely a shot in the arm for not just the property market, but the broader economy. I think what we'll see initially, based on the rate cut, is an improvement in consumer confidence, which absolutely will flow through gradually into the property market and also into the broader economy. You need to remember the property market has a real multiplier effect for the economy, because if there's more people buying houses, it also means there's generally more people buying white goods and home furnishings, and we're seeing new home building starting to ramp up and building products selling more. So the multiplier effect will be the most important thing, but I think absolutely without doubt it's a positive for the property market.
Now, Tim, I've written an article for this week's my blog this week, and I'm basically putting to the market that a change in government would make a massive difference, because we're essentially been in election mode all of last year, and we're back in it again now. And whenever we're in election mode, the market stalls. What are your thoughts?
That's exactly right. I couldn't agree more. You find consumers or prospective home buyers simply don't want to make a decision when there's uncertainty from a political standpoint, not just from state or local governments, but also from a federal perspective. So it doesn't do anything for confidence when we're in election mode, and you'll find that most prospective buyers are going to be sitting on their hands until there's some certainty returning to the market.
Tim, very quickly, and last but not least, rentals. If you're a tenant or you're a landlord, who's winning?
Well, at the moment, it's about neutral. So Adelaide's been a quieter rental market. We have been seeing rents racing ahead in Perth, for example. They're up about 14%. Sydney and Brisbane are seeing pretty strong rental growth. Over the last year, based on our figures, Adelaide house rents were up by about 1%. And unit rents were virtually flat or slightly negative. So that is impacting on rental yields. Yields are pretty much spot on the capital city average at the moment across Adelaide. So I suppose it does take some pressure off renters to some extent, but vacancy rates still seem to be quite low based on the REIA data. So that does suggest there may be some further upwards pressure on rents.
And Tim, final comment. You're in the property business, you understand it completely. What's your tip for Adelaide property owners or South Australian property owners? Would you be buying, selling, holding? What's Tim Lawless' advice?
I suppose for starters, looking at vendors, in this sort of market, you need to be absolutely realistic about your asking price and your price expectations. There's the number of buyers out there are relatively few compared to, say, back in 2009, and they do hold quite a bit of leverage. So you need to expect some cheeky offers and a bit of negotiation. So it comes back to the vendors being quite realistic. We can see that in auction clearance rates at the moment as well. They're generally averaging around the high 30s to low 40% mark, which is a little bit lower than what they were back in, say, 2009 as well. I think the market, looking forward, is going to be fairly steady as she goes. The interest rates will eventually start panning through to improved buyer sentiment, but that doesn't happen overnight. It will take some months, and largely depends also what happens with mortgage rates from the Big Four.
Tim, that's been fantastic. Thank you very much. Very comprehensive, but an incredibly important time in property. So thanks very much.
Always a pleasure. Thanks.
Now that wraps up this week's Market Update.